dig it, Satch?
Oh, what's good, everybody? Happy Tuesday. That's a great song, isn't it? I like that song. It always gets me going when I hear it. Let's talk about the markets because the markets could use some help getting going here. We've been up for the last 7 days. We'll go over to the charts in just a second, but today the stock market was lower. The Dow finished the day down 192, worst day in 3 weeks. S&P 500, same, down 18. Nasdaq 100 closed down by 59. For those of you just joining us, if you are customers of ours, if you just had your accounts funded with us, we have a class tonight. We do classes very frequently. Check the events tab on our website. Just go up to the top, click services, or go to the client center, and you can see the events there. Tonight's class is on how the wealthy position their accounts. I'm sort of the background where I got to watch this. I got to be a part of this and getting the wealthy to have the sort of setup that they need going forward. And that's why I started Jazz, right? I go over this all the time. To bring that same advice, to bring the same help, to bring the same wealth management to those that are just getting started. Well, today we're going to continue on that, taking what you're familiar with, that you've seen us talk about on YouTube, and going into great detail about specifically what the wealthy do as far as positioning their account types and positioning the investments in them. What are their greatest concerns and how do you compare to that? So if you have a moment tonight, join us 7 o'clock Eastern time. If you're one of our customers, you should have the invite in your email actually as of now. Just click that little button just before 7 o'clock. We'll see you there. Also, if you've never watched this before, we're an investing service. We help you with your personal finances as well. And all of our portfolio's performance can be found on our website, very first selection under services. We update them every Friday, Friday night, so that you know exactly how, if you were to join us here at Jazz, how would you do? But all of that aside, the marketing is done. Let's get into the markets today. Like I said, Dow was down 192, S&P sold off 18, Nasdaq lost 59. The Russell almost made it positive. If you follow the Russell 2000, that's a good sign there. Basically, it was kind of one of those days where anything that was sort of bad news hit the markets today. For the last 7 days, if we go over to the charts, we'll take a look at the S&P 500. For the last 7 days, all news was good news. There was no bad news to be found. Well, today that kind of all hit in one shot. It started off this morning with China announcing investments, retail sales, and what was the other thing? Home sales came in lower than expected, had global investors concerned that, maybe China is much softer than we had anticipated. That sort of set the tone to get things started. Then the Commerce Department here in the U.S. reported retail sales only increased by 0.3%, which was actually not bad. That actually wasn't a bad number. Had we not got the China news, that probably would have been enough for us today. But what it did do was start the conversation about the Federal Reserve raising rates more than just the twice that they're expecting. So we all pretty much know in June here, going to raise rates. You can almost bank on it. 100% of every analyst on the planet thinks they're raising rates, and so they'll take that opportunity. They will raise rates. Well, if we go into the next meeting, August, not 100% there, right? Not everybody is 100% they're going to raise rates. Well, news like this, that retail sales were doing well, further sort of pushes that mindset that, yeah, we're going to raise rates. Things are probably going a little bit higher. Well, that was the main story today. I'm going to switch back over to the charts and take you to the 10-year note. While everybody's focused on the 10-year note, the prices hitting new lows, yields hitting new highs, we got to 3.09% today. That's the highest level since 2011. That gets the media's attention, right? So what you're seeing on the charts there is the prices of the 10-year bonds, 10-year notes pushing below the logo. We always say in this little class here, anything that moves below the logo is in pretty bad shape. And so now you know that 10-year note is prices move inversely to the yields actually. So now you know the yields are just screaming higher. Big move today for notes if you follow along with that. More importantly, and I can't show it on the charts, I don't have that on my screen, the 2-year note. That is pretty interesting, right? If you can get zero risk for 2 years at 2.88, I think it was, versus 10 years at 3.09 or 08, wherever it finished, come on, where's the trade-off there, right? You're starting to see why people may suck some money out of the stock market and go put it in things that have no risk, quote, and get a pretty decent rate. So while a lot of people look at this and say, oh no, interest rates, it's crashing the market, it's really just money moving into a product that people haven't been able to take advantage of for almost a decade, maybe even a touch longer than that, depending on, no, almost a decade now. So big deal there for notes. That was kind of your main focus and will be the main focus as you look through the media headlines today. So we've covered that. We've covered China. We covered the Commerce Department, retail sales. One company that did not do so well with their retail sales, well, not as good as expected, was Home Depot. That's what you see on the screen there. The stock was down 1.6% today because they reported their earnings. Earnings basically were better than expected, no problems there, but sales were the problem for Home Depot. They got off to a what they call a, quote, slow start to their spring sales season, right? You guys are supposed to be out there buying grills and buying lawn furniture and those little gnomes that scare the hell out of all the dogs. You're supposed to be buying that stuff, and Home Depot says, actually, our overall transactions were down by 1.3%, so they're off to a slow start. I don't know what you guys are waiting for, but Home Depot seems to think that it was a longer than normal winter, and so for that reason, they're playing catch up with their spring sales season. Doesn't matter. Investors were like, you know, that's not good. That may be a sign of weakness. And so the stock was down by 1.62%. If you have an interest, you take a look at their competitor there, Lowe's. Lowe's was lower by 1% as well. They deserve all of that. That store is horrible. Horrible. I just do not like that store. Staying with retail because the focus is going to be retail oriented in the coming weeks, really. They're going to start reporting their earnings, and so we're going to take a look at Gap, symbol GPS. If you follow the Gap, shares were higher by 2.57% today. They got an upgrade from an advisory group. The advisory group basically said that all the promotional pressures that are really hurting the industry right now are priced into the Gap. Not the other stocks, but the Gap. And all that means in sort of fancy language is they think that the price right now is essentially undervalued and that you know, they're going to do a lot better once these promotions sort of kick in. So I don't know. I don't follow it that closely, but that's what that was in the news. Let's also move over to gold because you're probably going to see this in the headlines. Here is the actual price of gold. Current price at $1292.30. So gold broke below $1,300 for the first time since December, thanks to a strong dollar today. So if you participate in that side of the market, you're interested in that side of the market, gold certainly got your attention today. So something to point out, just something you'll notice there. I think that's about it for that. I want to point out one last thing, and I'm going to do a video about this because it's really starting to piss me off. This is happening more and more, and it never makes the headlines. But if you live in Colorado, then you are likely, well, you definitely are feeling the brunt of this. If you have a Colorado pension or PARA, you guys use the term PARA there, whatever it stands for, pension, employee retirement, whatever. They're in big trouble, right? They just passed a bailout where you people in Colorado are having to pay for the pension. So think about it, right? You're supposed to get a pension for working for them, and now you're just going to pay for it on the back end. They've adjusted the whole thing. They're raising the retirement age to 64 for new members. New members are also going to pay more towards their own retirement. The base benefits are not so generous anymore. They've raised or lowered the base benefits. And here's the big deal. If you live in Colorado, I feel bad for you here. What they did is they agreed on a bailout yearly to take $225 million from the state's general fund per year. This is not a one-time bailout. This is how bad it is in Colorado. They said, we need this much money every year, $225 million, taking it from the general fund. So if you follow politics or any of that kind of stuff, all that means is the pension you're supposed to get, you're just going to pay for on the back end now. You're not really getting anything, so there's no benefit there. I'm going to do a video on this because it just really frustrates me and further illustrates my point. You have to take control of your own retirement, your own investments. Don't let something like this happen. You manage it. Tonight in our class is going to be a great example of how this doesn't affect the wealthy because they don't position in this sort of way. I'm going to show all of our customers how we do that. I hope you can join us there. I don't want to get too pissed at the moment, so I'm going to leave it there. If you have a question, I'll take a second and answer those questions for you, and then we'll go from there. So let me take a look. Mark's a little concerned by the day today. Yeah, one down day, not a big deal. We broke up about 30-day highs. Expected to have some sort of pullback unless there's crazy good news. Oh, okay, you're helping him out there. Perfect, thank you, sir. What do you think will happen at as the yield curve flattens out? It seems to be held below 3% on purpose. I honestly think the Fed waited too long. I think, you know, a year ago was their opportunity to really pick up steam. I think they have a history of waiting too long. I think it's a mess. In the short term, as far as the yield curve flattening out, it just makes for a good headline. In the long term, it becomes an opportunity for some and a concern for others. I certainly buy into that. I would not take the moment to make any adjustments just yet. I think it's a whole new side of the market that whole generations have not seen. It's going to be amazing to get to do videos on this and to get to educate, because we haven't, it would have been stupid to talk about this for all these years. So looking forward to that, Mr. Financial Investor. Gap, you guys don't think Gap's doing well? I actually don't know where there is a gap, or if there is a gap around me. I couldn't say, actually. Hey, Dustin, what books do you recommend? All of them. I'm a big fan of books so long as you're learning a fact. I don't like the books where you read someone's opinion and they can sort of tell you what to think. I like books on investing and trading that are just teaching you the facts. Like, for example, we're going to do a class on the candlesticks. Just to show you what these blips on the screen is the real lesson. What my opinion is of how the stock responds when one candlestick does something or the other does something, that's an opinion. So I'm very careful not to suggest books where there's a lot of opinion about how to invest. I like the facts. Our portfolio performance on our website is all facts, right? We build and manage those portfolios based on facts. We don't guess, we don't pick stocks. So I really try to move my life in a direction where I'm either learning, teaching, or working based on facts and not opinions. So be very careful of that when you read books. There are a lot that have to do with opinion. All right, you like Costco, Lowe's, Home Depot, Walmart, Kroger. I think those are strong names. I think you nailed some ones there that are weak. Yeah, Sears, JCPenney. All right, gonna wrap it up there. You read Rich Dad, Poor Dad. Yeah, again, those are kind of opinionated books. You know, there's some sort of facts to learn there, but I'm more interested in the specifics there. I'll see if I can put together all the books that I have. Actually, a handful of them are back there. I like that Blink, the book Blink. Malcolm Gladwell, forgot his name. There's a couple others, so I'll put a book list together or something just to share with you the books that I've read and liked or disliked, if that's something you're interested in. In the meantime, I'm going to wrap it up there. We've got our class tonight. Hope you can make it. If you can, of course, it's recorded. We'll send it out to all of our customers, but that starts tonight at 7 p.m. Come have a glass of wine with me. Let's talk a little bit about what you could do a little bit better and maybe kind of put yourself in line with the wealthy. So we'll talk to you later. Have a great day.